Good afternoon and welcome to Ask the Expert Accountants. I'm Jack Milligan, Editor-at-Large at Bank Director, and we thank you for joining us today. This webinar is brought to you by Bank Director and sponsored by Clifton Larson Allen, LLP, Crowe, LLP, and Dixon Hughes Goodman, LLP. Before we get started, let me share with you a few housekeeping items. You have joined this webinar in listen-only mode, so you are automatically muted. For a better viewing experience, we recommend that you click on the sidebar at the bottom of the screen to put the presenters in full screen mode. We are offering CPE or continuing professional education credits for this webinar today. In order to qualify for credits, you must be in attendance for the full and complete webinar, and you must participate in all 3 poll questions. If you want to receive PE credit for this webinar, please email events@bankdirector.com. That's events, E-V-E-N-T-S, @bankdirector.com. Certificates will be sent out 2 to 3 weeks after the webinar. We encourage you to ask questions, so please note them by clicking the Q&A button found at the right-hand side of your screen. There is no need to take detailed notes. The recording will be shared with attendees within 24 hours via email and will be available at bankdirector.com. If you have any technical issues, just note those using the moderator chat feature on the right-hand side of your screen, and we will do our best to take care of it. On that note, let me introduce our speakers today. Sal Ansara is a partner at Crowe, LLP. He has more than 25 years of experience in accounting, consulting, and auditing. His experience is derived from his roles in both public and industry accounting. Sal specializes in working with SEC-registered companies and has significant experience in issues related to financial institutions. He has assisted his clients with strategic planning initiatives and stock offerings, including registration statements and audit committee education programs. Scott Klitsch is the financial institutions principal at Clifton Larson Allen, LLP. He has more than 16 years of assurance experience. Scott is a respected industry professional who has supervised all phases of audit work for many high-profile entities, including governmental entities. He regularly consults with clients on emerging accounting issues and audit standards as a member of the firm's National Assurance Technical Group. He is also the leader of quality over the firm's financial institutions practice. And John Tomberlin is the managing partner in the financial services practice at Dixon Hughes Goodman, LLP. John leads a team of assurance, tax, and advisory professionals focused on regional and community financial institutions across DHG's footprint. He began his career with DHG more than 20 years ago in the firm's financial services practice. Welcome to you all. Glad to have you here.
Thank you.
So, Scott, let's start with a question for you. And audience, please submit your questions using the Q&A button on the right-hand side of your screen. So Scott, what are the stages associated with a comprehensive and integrated due diligence process?
Thank you, Jack, and thanks for the question and thanks for the opportunity to be here today. So due diligence should really be a multidiscipline process that is part of the entire M&A cycle. Important to recognize that the value of due diligence doesn't stop at the transaction decision point or when price negotiations have been completed for the inclusion in a definitive agreement. We believe there's really 3 stages of due diligence. That's preliminary stage, detail stage, and then the final stage. In the preliminary stage, that's typically the stage that you have relatively limited information on your target, where you might be identifying risks, you're identifying potential strategies for synergies, you're developing an initial valuation model, and you're making really a yes or no decision on whether or not you're going to make an offer or move forward with the acquisition. In the detailed stage, this is when you're really sending in your subject matter experts and you're analyzing all the relevant financial and non-financial information as much detail as necessary. You're providing actionable information in that stage for further negotiations, for the deal structure, valuation, and really any information needed for the execution of any of those identified strategies and synergies. And then really in the last stage or the final stage, the focus there is on really updating and wrapping up items that feed into the definitive agreement. And you're really further refining that balance sheet valuation and synergies. And you're really trying to figure out how you're going to create that post-transaction value and laying out the plans for that. And finally, what you're going to do here is really have that final review through the closing date to ensure there's no material adjustments to the target's financial position or operation that have occurred or otherwise not contemplated previously and part of the due diligence process.
And Scott, how much time would you normally expect to set aside for a thorough due diligence process?
I would say the more time you have, the better. I think everyone wants to move these as quickly as possible, but we all know there's significant time constraints. I'm working with a deal right now, and given some of the sensitivity around the deal, there's not as many people in the loop, and some of that information flow is not moving as quickly as everyone would like. And so, I think really from start to finish, the more time you have, the better. I think a 2 to 3 months is ideal if you can get at least that much time. But I know some deals move very, very quickly, and I think some of those preliminary stages hopefully can happen through relationships that have built over a number of years, and so you're already familiar with the target and some of those synergies, and that you're going to operate well together.
Gotcha. Sal, a question for you on CECL. When comparing banks that have implemented CECL versus those that haven't, what analytical variances would you expect to see?
So the analytical variances that you would see, first you have to get into the details of how the details were put together. One of the confounding complications is that there are as many flavors of CECL calculations as there are Baskin-Robbins ice creams. And so it's difficult to compare two static numbers without understanding the composition of how that data was derived. And so when we're chatting with our clients as they're moving from a non-CECL, from an incurred loss model to a CECL model, and they look at the first ending number and they try to determine the relevance of that new number, they have to parse how they got there in the first place. And then the other aspect is when they're comparing their new number to what they see in the market with those banks that have already applied the standard. And what I suggest our clients do is to understand the composition of the comparative portfolio, to understand that a significant influencer in the calculation is the life of loan. And so if you have a CRE portfolio and the bank that you're comparing it to using a drastic variant is a heavy C&I portfolio, your allowance may seem very heavy as compared to the C&I portfolio, but that is impacted by the much longer duration of that portfolio. And so the simple answer is that you're going to have to reevaluate the composition of your baseline in order to determine how that baseline compares to your number and how you get to that number. One of the other things that we are focusing on is making sure that as you aggregated that data, that there aren't any data errors in there, and those data errors can also suggest an answer that is incomparable.
Thanks, Sal. And John, a question for you. With the COVID deferral of TDR accounting on modified loans, how do you see the unwinding of this deferral, and what impact could it have on banks?
That's a great question, Jack. And as we think about the TDR guidance that has come out, especially when you might be thinking about acquisitions and looking through what might be in a target's portfolio, the TDR guidance is really more of a classification of these loans. The accounting for those is really going to follow the impaired loan accounting. Or depending upon if you've already adopted CECL, whether you're looking at those as part of individually identified loans and individually reviewed loans or part of the pools. So first being able to understand, one, has CECL been adopted at the banks, both the target and the acquiree, the acquirer, and then being able to look at from a TDR standpoint, while the TDR guidance has been deferred, the accounting for impaired loans has not. So if you know that you have an impaired loan and you know you have a loss on that loan, you still need to be going through and putting a specific reserve, or writing that loan down to the net realizable value of that loan. So while the TDR guidance, and who knows what's going to happen between now and December 31st or January 1st when that gets scheduled to run out, there may be an extension of that, but really there shouldn't be a big accounting debits and credits difference to that, because those impaired loans should already be identified, should already have a reserve upon them. And then looking at when the TDR guidance does roll back into play, it's more of the disclosure of loans that may have received a modification due to troubled debts and so forth.
Gotcha. Thanks, John. So let's go to our first poll question. This is a question about CECL. For institutions with a CECL effective date of 2023, how much time has your bank spent getting ready? And here are the answer possibilities. We are currently preparing and have been for the last 12 months. We are currently preparing and have been for the last 6 months. We are about to begin preparations, think it will take 18 months. We have not begun preparations, but think it will take 12 months. We have not begun preparations, but think it will take 6 months. So attendees, please register your answers. And then I'm going to ask each of our experts to give their thoughts on what we find. Okay, so let's look at our results. We are currently preparing and have been for the last 12 months. That's 52% of the participants. 33% said we are currently preparing and have been for the last 6 months. 0% said we were about to begin preparations and think it will take 18 months. 15% said we have not begun preparations, but think it will take 12 months. Then 0%, we have not begun preparations, but think it will take 6 months. So, Scott, what's your reaction to those poll results?
Just as an auditor, that warms my heart a little bit that our clients are and a lot of banks out there are preparing, and not only are they preparing, it sounds like they're either running parallel, they're working out the kinks. If you haven't started, I would say you're definitely behind the curve, and the CECL, and I mean, so many people are focused on the loans and do we have the right approach, the right model? Is it getting the right input and outputs? But there's other things too, disclosures, right? Sometimes the disclosures are an afterthought. The impact to the investment portfolio is an afterthought. So I really like those results, and I'm kudos to the audience here that's very prepared.
Sal, what are your reactions?
to Scott, it's good that we know that folks are on top of it, but as a witness of somebody who of banks that have already put processes in place and now are, I guess, in year 2 of the CECL process, to believe that this thing has a beginning and an end is a false premise. It's a beginning, it's a reevaluation, it's a reevaluation, it's a reevaluation. And so for those who, even if you think you're close to the end of the process, I challenge that thought, and I suggest you go look at the results of early adopters who had significant transitional impact to their allowance because things that they had thought were built into the model and assumptions that should have been contemplated in the model were not, or did not have the amount of gravity. They did not assume the amount of gravity those changes in assumptions might make. And so even if you think you're close to the end, I would try and apply assumptions to the model that are outside norms and see what the reaction to your allowance calculation is. The other thing is that for those banks that were in the process of implementing in 19 with the 20 adoption date, there was an assumption at the time that the qualitative factors would be less impactful to the allowance calculation. And that could be no less true, a statement that could be offered. In many cases, the qual factors, which were originally projected in many cases to be 10 to 15% of the total allowance, are now very significant to calculation, and something that was first time for many of my clients. Many of the qual factors were negative, and that you had to pull down the quantitative calculation because the details going in the quant calculation were not moving quick enough to reflect the actual activity that was in the economy. So I'd suggest not getting comfortable where you are relative to where you think you are in the completion of the process, and don't believe that at the end of completing the process that you're going to shut the book on it. It is a continued reevaluation from that point forward. Don't look at this as having a open by Christmas due date. It doesn't work like that.
John, a bank with an effective date of 2023, where would you think they should be right now? And clearly, they're not the last group of 6 months out. They haven't started yet, but they think this will take 6 months.
Yeah, that would certainly give me some pause for concern if I was in the camp of it's going to take 6 months and we've not quite started yet. One of the key things that we've learned here is it takes significantly longer than you had anticipated. Even those that started early and really thought it was going to take much longer. One thing to keep in mind is the previous model, the incurred loss model, was a model that was around for 30 years, and we still had financial institutions that struggled to be able to properly implement it and get it documented. And now, with a brand new standard that is one of the biggest changes in the banking accounting during any of our careers, to think that you're going to have it exactly right on the start is just not a reasonable assumption. And so to really support Sal's point that he just discussed is you may have gotten to a good start. You may have gotten a pretty solid model. You may have gotten a good model validation, but the continual tweaks of the identification of risks within your portfolio, and are they being captured in this model, and the documentation that is going to be necessary on those qualitative factors that are necessary to adjust it are continually going to be a work in process where it's going to need to see improvements, better documentation over management's assumptions and their rationale for those assumptions. So Jack, I would just say, if you're in that, it's going to take 6 months. Please do yourself, your bank, and your auditors a favor and reevaluate that, get started quicker, because it's going to take longer than you expect.
Hey, Jack,
Right.
one other point that I could bring up. The Federal Reserve has offered somewhat of a lifeline, this thing called scale. And we continue evaluating this model, which aggregates those banks over $1 billion, their CECL results, to establish a baseline for banks to use as part of their modeling. And as an auditor, that kind of troubles me because I don't know the relevance of that data. And the banks that might apply that methodology don't have the supporting details as to how that data was aggregated. And for those that are in that 6-month window, if in fact that was the model that you're planning on using, you need to recognize a couple of things. One, only the Federal Reserve has accepted that methodology. So if you're an OCC bank or a state charter bank, your regulators may not have accepted that methodology, and that from a supporting standpoint, you may have diligence that you need to do that you don't have access to that data. So if you were using the 6-month window and saying I'm good because I'm going to use the scale, I would challenge that method, that thought process.
Great. Thanks, Sal. We have a question from our audience. Let's take that. I'm going to ask Scott to react to it first, and then Sal and John in turn. How does purchase accounting change in a transaction with the adoption of CECL? Scott?
Yeah, and I think Sal touched on that a little bit in his first question, and I think it impacts a lot of different things. So first you need to determine is the target and the acquirer both on a CECL model, is one on an incurred and one is on a CECL, or vice versa. You really need to understand that the allowance isn't necessarily equal to the credit mark that's going to come out of evaluation of that loan portfolio. There's still some issues that FASB's retaking a look at recently, which I think a lot of people are very happy with, around kind of this concept of PCD, non-PCD, and in one scenario you have to take that CECL allowance as sort of what I heard call it like a day two, right? You have your fair value mark, and then on top of that you got to do your CECL mark. And so I think there's a lot of complexities there, and FASB's still thinking through some of those complexities. We have a lot of smaller institutions that might be the targets that are on the incurred loss model. They might be through that process of CECL, and you're going to have to start combining those data sets. So if the acquirer has already adopted CECL and they're using one model, and that target was planning on using a different model, how does that integrate? How are those results used as part of that due diligence and valuation process? So there's definitely some complexities there. I think definitely it's an opportunity to bring in your auditors, the valuation specialists, and really understand how that could impact pricing, how that could impact apples to apples comparison when you might be trying to do a book value price, those types of considerations.
Sal, what would you add to that?
I'd echo one point. The double counting of the allowance is critical to the understanding of the economic value of the transaction. And FASB has suggested they understand the question, but they're looking for situations where it's impacted transactions. And fortunately or unfortunately, the investment banking community, and when doing their analysis, negate the double count in order to determine the economic value. So I at first I was hopeful that there would be change in this situation, but I'm not so hopeful that change is coming. But when I think it's very important to understand that when putting together the numbers on an offer of a deal, that you need to project that on day one, especially if it's a sizable portfolio, your net income for that quarter that you report is going to be sizably impacted by the establishment of the allowance on the portfolio that is not deemed purchase credit deteriorated.
And John, what would you add to that?
I think Sal and Scott have nailed it. It's the double counting that's the issue. And as a director, I would look at it from a standpoint as how is that impact going to affect the P&L on that first quarter, as just as Sal said. So while you're day one, you're going to be bringing over all of those acquired assets at fair value. In day 1.1 or whatever you want to call it, which is not the same as the purchase price, you're going to have a P&L impact for an allowance expense or an ACL expense for that good portfolio. And that's where that's where the rub is. That good portfolio is going to get a double counting of allowance, one from a fair value and building of the allowance on your balance sheet. We did hear recently one of the OCC chief accountants is very strongly in favor of keeping it that way. We did hear a little bit recently from the FASB saying that there is that they are looking at it and there might be some opportunity there, but they were obviously non-committal at this point.
Okay, great. Thanks. We're going to come back to CECL in a moment because we have another question from our audience, but we're going to switch it up a little bit with our second poll question. This has nothing to do with accounting, but I guess everything to do with lifestyle. It's a question about working remotely. How much of your bank's workforce is fully remote? None, under 25%, 25 to 50%, or greater than 50%. We're just going to wait a second for the results to be tabulated. So, Scott, the results are still they're still tabulating at Clifton Larson Allen. What's your remote workforce situation?
So for our firm perspective, I would say we're probably right at that 25 to 50% fully remote. Encouraging people to be back in the office, but it's a personal choice and it kind of what works for you and what you have else going in your life and comfort. So, that's kind of where we're sitting from our firm perspective, which is probably consistent with what we're seeing on a lot of our clients right now.
Okay, so we have the poll results, and Sal and John, I'm going come back to you in a second, but this kind of surprises me. 18% said none of their workforce is fully remote. 45%, the largest category by far, said under 25%. I would have thought that category was larger. 27% said between 25 and 50% of their employees are remote, and just 10% said greater than 50%. So I would glean from this that well over half have most of their people back. What's the situation at Crowe, Sal?
Well, I'm going to challenge that thought process a second. So I never understood the magic of 5 days in the office. And so maybe when the response is remote versus non-remote, what we're seeing is a flexible schedule. And for those that have a flexible schedule where 3 days a week you're in the office and 2 days you're out, that suggests that they are no longer remote, but there is a remote application there. And then the other thing I would suggest, Jack, is that we seem to view this as an on or off switch, as opposed to a switch which is based on level strategic initiative performance, things of that nature. If Bob is a trusted doer, I can trust Bob to be wherever he is to do. If Bob's a new employee and needs training, Bob needs to come to the office because Bob needs supervision. And if Bob's a strategic thinker, some of the best strategic initiatives happen by accident and because people are working together in the same environment. And so I think it is somewhat of a false premise to suggest that it's remote versus non-remote. And I think you really got to get back to my Baskin Robbins flavors thing. I think you got to break down your composition of employees and decide which of those employees are okay to work remote versus not. As it relates to Crow, prior to the pandemic, we had an established group that we refer to as CAST that only work remotely. And that's about 10% of our staff. And they are doers. And so it is fine, and they've been hired as experienced hires, and they continue to work remotely. But as of, I want to say, probably in the last 3 or 4 months, particularly for those who are on the less experienced level, we're making accommodations and making sure that our more senior people get to the office in order to have active training and make sure that they're supervised. And right now, where I am right now is in an office in California where our entire team on an engagement, the client will not allow us to work in their space, but we're working in aggregate so that we can collaborate together. So I think that the view of where we're going is going to be less defined as Monday through Friday, 8 to 5 for all employees, as opposed to segregating the employees by responsibility, the availability to work remotely, and then parsing that based on those skill sets.
My sense was always that professional service firms, especially accounting firms, the partners often work remote. I mean, it's not unusual to go and visit a client, and so have laptop while travel. So I would think it would be less of an adjustment for you, John. What's the situation at Dixon?
Well, I'm not surprised by the polling results when I think about our clients that are financial institutions. I have seen more of back to in-person with my bank clients. They may not be necessarily ready for third-party vendors to come in and be in their space, but certainly they are looking. Their people are back to working or at least, if not every day, or 2 to 3 days a week on a rotating schedule. But at Dixon Hughes Goodman, we have fully embraced the technology advances that we've made over the last year and a half during the pandemic. It's one of those things that's going to be hard to put the toothpaste back in the tube. We have proven that we can work remotely and be effective. But really the approach we're taking is more of a hybrid. We have termed it our DHG Anywhere. And that's where we will work with our clients and our people to be able to find out, one, what do our clients want? Do they want us on site, or do they want us remotely, or do they want us in some hybrid approach from that? As well as taking into consideration our people and the training that they need, the coaching that they may need, what do we need to do to help them to be able to have a great career. One of the advantages of being in public accounting is the people that you get to rub shoulders with and be next to, people that you're able to learn from and see interactions with. And so that's a key part to it. And so we're looking at this both from a standpoint of we want to provide the flexibility as well as to be able to provide that human touch and that human interaction that we all learn so much from. Another piece to this, Jack, that's very important is the challenging workforce that is out there right now. Those that are going to require all of their people to be in the office all of the time are going to be limited to who they're able to hire. Those that are only in their geographical area or those that are willing to travel a lot. I think with the workforce in the war on talent right now, trying to find good talent and retain good talent, being able to be flexible and offer those different kinds of hybrid approaches is going to be key in one, retaining good talent, and two, being able to attract additional talent.
Yeah, and I strongly suspect that the quality of life genie is out of the bottle. So people have been working at home. Many people have been working at home for 18 months now. And that definitely has a huge impact, particularly in large urban areas where there's a long commute. I mean, if you're living in Chicago, if you're living in New York, LA, San Francisco, Atlanta, Houston, I mean, pick a big city. Having 2 or 3 days that you don't have to go into the office can make a big difference. Well, let's get back to it. We have another CECL question from our audience, and John, I'm going to stay with you. For CECL adopters, it seems like most increases in reserves are going into GVAs, not specific reserves. At what point do these GVAs have to become specific reserves before those GVAs are not supportable? If those GVAs never get used, how can the accountant support them?
Well, there's a couple different elements of your CECL model that you'll be looking at. Most models that I have seen and that are out there look at and take some sort of pooling approach to those loans. Those loans are going to be pooled either by call codes or some other homogeneous risks that are prevalent in the portfolio. And as the model is developed to be able to capture the anticipated losses throughout the life of those loans in those respective pools, then those are not looked at from a individual loan by loan basis. It's looked at the pool level. Okay. Now, in addition, the guidance in the standard, the CECL standard, allows you to be able to make a policy decision on how you will treat individually identified loans or individually evaluated loans. So if a loan that is in one of those pools starts to experience some kind of credit deterioration or no longer has risk characteristics that are similar to the loans in that pool, meaning that those risk characteristics have increased significantly, then based on the policy that has been chosen, those can either be retained in the pool and be impacted by the allowance, and there's some mechanism in the model to be able to pick up those loans as far as loss factors, or the policy is that they can be separately identified and evaluated, much like we were doing before with the impaired loan analysis, to be able to determine, is there some specific reserve that needs to be applied to those loans. So really the starting point of that is, well, what is the policy on that? Is the policy that they stay in the pools, or is the policy that they are to be individually evaluated? I think that was what the question was getting at, Jack. You can straighten me out there if I missed some aspect of that.
Well, I can't straighten you out because this is way over my head, but I'm going to ask Sal. Quite honestly, I'm going to ask Sal to add what his thoughts are.
I'm aligned with John. The only other aspect, I'm surprised by the jargon. If the person is asking about the Q factor, the amount of lineage on the Q factor versus historical activity and quantifiable, as I suggested earlier, if you asked me pre-CECL implementation, if we would have a large Q factor out there, I would have suggested no. And I would have never thought to have a negative Q factor at that point in time. So I would expect that as charge-offs increase, that as updates on debt service coverage ratios become more evident, that the quant part of the calculation would pick up a significant part of the allowance, either bring composition of the allowance, either bringing it down rationally or increasing it for charge-offs, and then your qual factors will become less relevant as part of the calculation. The qual factors are now relevant because the static data that goes into the model is in arrears, and you have to do something in order to reflect what you know to have happened since your static data was originated. Alternatively, if they were really talking about specific incurred loans, I think John's right on point.
Scott, would you add anything to that?
No, I think Sal and John kind of hit the right topics there, and I don't know if they were maybe hinting at a little bit of kind of thinking through the model, right? If all the bad loans, right? If you have a pool and all the bad loans go bad, are you left with just good loans, right? And if you have just good loans left, do you need a CECL? Do you need a an allowance there? And I think I think that's maybe a little bit of a false premise. You're constantly updating your analysis, as Sal mentioned, with your Q factors, updated historical information. New loans are coming into your portfolio, and so it's kind of a consistent, as we talked about, a consistent update and evaluation, and it's not a set it and forget it in any means whatsoever.
Scott, a question for you, and we're sort of back in the realm of M&A. What considerations should be given to major contracts that are in place? Target, I assume these would be vendor contracts of various kinds.
Yeah, that's a great question, and I think it's a key area of the due diligence process is to focus on those major contracts, and really the big three. You touched on one, but really the big three are core and ancillary system contracts, any change in control provisions and employment agreements,
right,
and any retirement plans that really do exist. And really not surprisingly, the core system and the ancillary system contracts, I really listed here first. And that's because more often than not, they create the higher level of frustration. Excuse me. And from the experience, that frustration can really continue from the first day the acquirer has a conversation with the target all the way up until the date you ultimately deconvert and move into the final system. In most cases, there's going to be more than one contract that need to be dealt with. Especially when you start looking at those ancillary systems that most of the core processors offer. And that's not so much that the contract can be the problem, it's that, they might have different expiration dates from the core, different termination fees might look very different, and how that termination fee might be calculated or determined can look very different. And as I mentioned, he's got to consider those deconversion costs, as part of that economics of the deal. So you got to make sure you do have that complete inventory of any significant contracts that the acquirer has, that they've reached out related to the core system, and they really understand those costs of those bolt-ons that have accumulated over a period of time. And it's important that the acquirer have somebody on their team also looking at those termination fees and not just completely relying upon the target to calculate those. And it's also important to understand who's going to pay any termination fees or deconversion costs, right? So under, ASC 805, the acquiring entity is not allowed to record transaction costs and restructuring costs of an acquisition, right, as part of the purchase price. And so if the acquirer is going to pay all those costs post-acquisition to deconvert, that might have an unfavorable P&L impact, right? If that entity is going to pay for all those conversion costs and get that kind of taken care of prior to the deal, that might get you a different answer. So you just need to understand how those costs are going to play into the purchase price and the future economics. I won't really spend a lot of time on the employee agreements, but it's really important to understand those change in control provisions. We had a recent deal where there was a 3-year term, and on that change in control, it renewed that contract all the way back to a fresh 3-year term. And so, the original thought was, hey, we're in year 2 of a 3-year contracts, but really with that change in control, it started a fresh 3 years. And there was some significant terms in there around, reduced responsibility, reduced compensation, ability for that executive to essentially decline an offer to work at the acquirer, and that might require full payout. So I'd say that, those are really the significant contracts we see. And I think everybody thinks about them, but they don't always think about the economic impact kind of post-deal that's similar to CECL, right? Of what's that first quarter after the acquisition going to look like from a P&L perspective? How's that going to impact, return on equity, return on asset type calculations, those types of things.
Gotcha. Sal and John, I'm going to come back to you in a second, but I want to do a third poll question. This is about differentiation, strategic differentiation. And audience, this is the poll question. What area is most attractive to your bank when it comes to differentiating it from its competitors? Niche banking, banking as a service, tech-enabled services, branches, or new or complementary lines of business? And we'll wait a second for the poll results to be tabulated.
Jack, while that's being tabulated, if I may, the only thing that I would add to kind of what Scott talked about is one thing that I would say is be careful with the notion of who's going to pay for the expenses in that merger for contracts. The actual accounting of whose books it's going to go on is not necessarily dependent upon who paid for it. You can have some instances where there may be a termination fee that an acquiree is asked to pay for, but that's clearly a benefit to the acquirer. And despite the fact that they may pay for it, there's going to be an expense that's going to go through on the acquirer's P&L. So I would just say be careful of thinking of the accounting following who actually paid for it.
It's been my impression that employment contracts, and especially change in control agreements, can be problematic sometime if the acquirer didn't understand exactly what the total of all those contracts were. If they were granted quite liberally by the target bank, the senior management team, if all exercised, that could actually impact the cost of the deal, correct?
That is a painful lesson to learn if you're not paying attention to it. So yes, you're exactly right, Jack.
So we have the results of the question about differentiating oneself from competitors. 14% said niche banking. 39% said banking as a service. 18% said tech-enabled services. 11% said branches, and 18% said new or complementary lines of business. So banking as a service at 39%, the clear leader. Honestly, that surprises me a little bit, Sal. I didn't expect that banking as a service was quite the thing with a lot of banks, because it is a bit unusual, stepping out of what their traditional role has been. What are your thoughts?
There are only, I'm going to go away from my Baskin Robbins suggestion. I'm going to say there's only so many flavors of vanilla. And the problem is that community banks are kind of limited in what they can and what they will offer. The beauty of banking as a service is it really doesn't result in me having to create any additional process. I'm allowing a retailer, for instance, to finance the purchase of a lawnmower, and it looks like to the purchaser that it is through the True Value hardware store, and instead it's going through ABC Bank, and ABC Bank is just utilizing the system and processes that it already has and catching a fee for it. So it allows them to utilize processes that they already have in place and expand the volume on those platforms. The item that we are cautioning our clients on is to understand that when you allow banking as a service, you also have responsibility for all of the related compliance aspects. And so if there are misleading or untruthful disclosures, particularly with regard to maybe rate or fees or things of that nature, that the front end provider is suggesting to the customer that is false or not completely transparent. You as a bank are responsible because it's on your platform and you are the regulated entity. And so it does not surprise me that banks are interested in doing this because the other opportunities that you have listed there, being, for instance, niches, that requires us to go hire new specific talent in order to execute in niches. When you add in a niche, you don't. One of my old major concerns was when I saw a CRE lender becoming a C&I lender, and the thought process of those two skill sets, it cannot be more vastly different. And so if all of a sudden you're going to be lending within, for instance, using cryptocurrency, you're going to take your C&I lender and I'm now going to lend on cryptocurrency. Well, that's a completely new risk profile that you're going to have to introduce new controls, new people, so the banking as a service, I can almost plug and play that one if I put the controls over the issues of compliance, where the other niches are going to require significant differentiations in talent that my bank may not have at this point. So it really doesn't surprise me. I just haven't seen 39% of my clients engaging in that service.
Scott, vanilla is my favorite flavor, so I would dispute Sal. I think there are actually many different varieties. We don't need to go there on this webinar, but were you surprised that this many such a high number of 39% of the attendees were interested in banking as a service?
Well, I think one of the things that you're looking at there is when it comes to banking, we want to certainly have our core in the services we provide to our people there. And so, while it doesn't surprise me that the percentage there was on that category, putting that into practice and actually putting that out there to the customer, and that being what's leading your bank may not be necessarily completely aligned and connected. So I know there's certainly a lot of banks that want to go that route and want that to be the leading edge.
Scott, we have.
So
go ahead.
Just Jack saying, yes, I do agree with you. The number's a little higher than I would have expected to be, but not higher than I think what banks would want that to be. That makes sense.
Scott, we have another a question from the audience, and we have about 8 minutes left for the webinar, so I'm going to ask you to respond to this one first. What advice do you have for community banks to remain competitive in the digital blockchain world?
Oh, wow, that's a good question, and I think we hear a lot about blockchain. We hear a lot about cryptocurrencies, and I think we probably hear more about it than what's actually happening, especially kind of in the community bank or smaller banking base. I think what's most important is an understanding, right? You have to understand how it works. You have to understand all the tentacles. When you say blockchain, that can mean a lot of different things. That can mean a ledger, right? That can mean a cryptocurrency. That can mean a new way to potentially trade securities and make that real time. And so blockchain goes well beyond just maybe like, oh, we have some Bitcoin, or somebody wants us to invest in Bitcoin. And so I think it's very important that people get educated, understand the risks, understand that it's cutting edge, understand that there's not a lot of guidance out there from an accounting perspective, regulatory perspective, et cetera. And so it's not something you should just jump into because you think it's a new exciting opportunity. It's something that I think is here to stay. It's something that we have to be willing to understand and embrace. But it's important that you fully understand what you're getting into if you go into that space. Be interesting what Sal or John have to think about that.
What would you add to that?
Well, I think over the next few years, and probably not very long time frame, we are going to be very uncomfortable in the banking realm with some things that we have stayed away from. The cryptocurrency is going to be one of those, in the fact that there's no regulation behind it, and we're in a highly regulated industry, and so that makes us very uncomfortable. So we've got to make some strides on that side of things. The other one I would say is the cannabis banking. Those are two things that I would say over the next couple years are going to be things that we have traditionally been very uncomfortable getting into that we're going to have to figure out very quickly.
Sal, sort of a variation of this question for you, and we've got a little less than 5 minutes left in the webinar. I did a board presentation on Monday on the topic of technology, and a question that came from the board that I was talking to afterwards was, I thought it was interesting, how good do community banks need to be in the digital space with their products compared to, pick one, Bank of America, Wells Fargo, Chase, any of the large banks, Citi, that are investing, multiples of $1 billion a year in building out their digital platforms. And I won't share what my answer was because I'm not sure it was the right answer, but I'd be interested in hearing your perspective.
So thou shalt know your customer, right? The banks that you mentioned are highly retail banks, and those are checking accounts with individuals or folks who are using bill pay, things of that nature. And if your customers reflect that kind of profile, you don't have a choice but to engage and compete with them. We are right now in a very unusual place where the level of non-interest deposits is probably at an all-time high. And for those deposits that are not in non-interest, are paying minuscule interest rates in the first place. And if you forego the opportunity to capture those accounts and allow the big banks to take them all, at some point in time, we're going to be back to brokered CDs and time deposits, which have a higher cost of funds. And as a result, banks live and die by NIM. And if I continue to add fixed rate loans in the current economy, and I have in front of me a potential of reallocation of my non-interest deposits to interest-paying deposits, I'm going to get squeezed very badly. So as long as your focus point is going to be retail accounts, you do not have a choice. If you're an ag lender or a CRE lender and you live off of your business model lives off of purchased funds, maybe not the biggest thing in your life to do. I do want to come back to one thing on the crypto space, which kind of ties in to the digital era. My sense is you're not going to have a choice. As stablecoin becomes more and more relevant, and Walmart is going to want to accept stablecoin. And the reason why they're going to want to accept stablecoin is because there is no variability in the value, and the transaction cost is about 1/2 the cost of transacting over a MasterCard, Visa, or Discover card. And so they are going to be more than happy for Jack Milligan to come in with his phone and pay with stable coin, which will probably cost him 75 bips as opposed to 175 to 2 bips. And now your retailer is going to be sitting on digital currency, and you're going to have to accept that as a deposit. So wanted or not wanted, I think, like in many situations, your customer is going to define if you're going to have a digital footprint and compete with the likes of Bank of America, Wells Fargo, and JPM.
Well, great. Well, we're really just about out of time. So, Scott and Sal and John, I thank all of you for your time today. I thought this was a good webinar. I thought your insights were really valuable. For the audience, as a reminder, you will receive the recorded version of this webinar within 24 hours. And we will also post this webinar on bankdirector.com. Again, to the three of you, thank you so much. And Sal, I will follow up with you later about the issue of various flavors of vanilla. So, thank you all a lot. I appreciate it. Everyone take care.
Thanks,
Thanks, everybody.
Good night.